a decent level of annuity is just 23,000, and the Lib Dems would like to reduce the lifetime allowance from 1.25 million to 1 million. An interesting thought that. It's also worth bearing in mind that when the lifetime allowance was introduced, the annual allowance was 215,000 a year, rising to 255,000, and you could see why, with levels like that, people needed to be limited on their total. We're now down to 40,000 annual allowance, and the only way people are going to exceed 1.25 million is by taking risks and getting better performance. And it seems strange that they're going to be penalised in that way. I wouldn't think that'll disappear overnight, but we could see the LTA disappearing completely. Okay, annuity guarantee periods. Now, we're all familiar with annuity guarantee periods. From an occupational pension scheme, the lump sum can be paid at the discretion of the trustees, and it's therefore tax-free. On the other hand, most guarantees under personal pensions are paid to the estate, and the capital value of these payments is then subject to IHT. Any of you that had the misfortune of having to complete the IHT 400 and 409 in particular, the section that covers pension payments, will know that you have to get an actuarial value of that capital sum for tax treatment. Now, annuity guarantees are a big problem because a lot of people say, I won't buy an annuity because if I die early, the insurance company will keep all of my money. And you'd all be aware that since Finance Act 1970, the maximum guarantee has been 10 years. Now, in 1970, when we saw annuity rates as high as 15%, a 10-year guarantee did mean you got all of your money back. But nowadays, that's certainly not the case. And after FD, guarantees of any term will be permitted. And to me, this is a huge sales point for annuities. I have to say it's not been picked up very strongly by the media, but it's something that I've personally been pushing. So the obvious question is, though, what will they cost? Because clearly people like guarantees, whatever sort of guarantee they are. A guarantee that gives you your money back if you die is worthwhile, providing it doesn't take half your money before you die. So I've got some examples here for a smoker. Age 65, single life level is the simplest form of annuity, but he is a smoker. And the no guarantee rate is 3,200. And what will be fun is, while I'm going through the different guarantees, you might want to think ahead and think, I wonder how much the different guarantees will cost. So the G0, the no guarantee rate, as I said, was 3,200. The rate with a 5-year guarantee is just 0.6% lower at 3,180. It's virtually unnoticeable. And indeed, if you had a joint life rate at age 60 with a male 65, you probably wouldn't notice the cost of a G5. That returns 32% of the capital, though, and isn't really a response to the insurance company will keep all my money. Go to 10 years guarantee, and we're now 3,100, which is 3.1% lower, and you're getting 62% of the capital back. So the level of payment is down a bit, but you're getting nearly 2/3 of your capital. That's what's been available up until April. What will become available is a 15-year guarantee, and there we're seeing a rate of 2,900. Now that's 9.4% lower. That is quite a significant reduction, but it does return 87% of the capital. We may find that that's the sort of level that people go for, less than 10% reduction, most of the money coming back if they die. G20 takes you to 2,630, nearly 18% lower, but it does return all the capital. At this stage, no one's talking about whether they would offer a 19-year guarantee or 18 years to try and maximise the income and return 100% of the capital. But we can still see that that is quite a respectable rate. Interesting thought that if you've got 3,200 as a rate from a competitive provider, we know that possibly as many as 60% of people will take a rate as much as 20% lower from their in-house provider on a rollover transfer. And in that connection, I'm pleased to say that a company that I have often knocked for the fact that their rates have been 20% below the market, Scottish Widows, have recently introduced a rate corridor where they are guaranteeing to be within a certain percentage of the best available. So at least that's a company people can roll over into without a huge loss. It only leaves about 25, 30 other companies who will roll you over into an annuity that's complete and utter pants. 25-year guarantee, I haven't shown the percentage reduction or the percentage capital returned, and 30-year guarantee. So a 30-year guarantee, you're giving up a third of your income, but you're actually guaranteeing that you're going to get back something like 20% more than the original investment. So it's difficult to see who would want to do that, but if you're looking at estate planning, maybe that is something. The figures above are based on figures that I've got from Just Retirement. They're not currently available for annuity purchase, and I've been asked not to take them to the press or anything like that. So hopefully none of the delegates will do that. But I think it's certainly an interesting concept, that the idea that I die and the annuity company keeps all my money, it doesn't need to be the story anymore. It was, of course, never a true story, because if you die, the insurance company pays the money to Henry Allingham. And for those of you who don't remember Henry died in 2009, aged 113. He'd had a state pension for 48 years, and the annuity that he bought at age 60 paid out for 53 years. So annuities can work for people. All you have to do is live a long time. Now, the new option under pensions will be cashing out. So what happens there? Well, 75% of the fund is subject to income tax, probably a large part at 45%. Some of you may have seen the discussion in the trade press recently of the problem that if you take a big lump of income in April, PAYE assumes that you're going to take the same income every month throughout the year, which is why everyone will pay 45% probably under emergency tax. But when it's all sorted out, they're still almost certain to pay 40% tax on at least part of that money withdrawn. And the cases that won't pay 40% tax are people with very small funds, and unfortunately they aren't the sort of people that we can afford to provide advice to, and I imagine our listeners will have the same problem. The retained cash, of course, forms part of their estate for IHT, and if they aren't able to gift it within 7 years of death, they're potentially exempt transfers, which means, again, IHT. IHT, of course, currently at 40% with an allowance of 325,000, which has got frozen of late, although you can, of course, have a two-person allowance carried over, giving you 650,000 cover. Drawdown, how it was introduced in 95. Those of you who've been working in pensions for 20 years or more will remember the day. You must annuitise in the old rules by age 75. Death in drawdown lump sums were taxed at 35%, which was based on the fact that you were either a basic rate taxpayer or a higher rate taxpayer, and 35 was somewhere in the middle. This was before tax rates fell to their current levels or the introduction of the additional rate of tax of 45%. 2006, alternatively secured pension was introduced. This was one of these wonderful terminologies that the government and the revenue have used. Alternatively secured pension, an annuity is a secured pension, drawdown is completely unsecured pension, but they called it alternatively secured pension. And they said it was for the Plymouth Brethren because they had objection to taking advantage of someone else dying and mortality subsidy. But funnily enough, all of the clients for whom we did ASP were not Plymouth Brethren. 2011, George Osborne, which unfortunately I've misspelt, increased the death tax to 55%. I only mention that because it was the same George Osborne who decided recently that the death tax was unfair when he abolished it. 55% applies on activated segments pre-75 and on all segments post-75. Dependents' income is taxed at marginal rate. How will it be? Well, a significant change, certainly. The key factors are going to be the age at death and the date of payment. Any payment paid before 5th of April, regardless of the date of death, is subject to the old rules. Any payment paid from the 6th of April onwards is subject to the new rules, regardless of the date of death. So, important point, we've actually got a client, or a former client, who died in December 2013 and whose beneficiary was so certain that the tax was going to change that we think he must have connections with the politicians, but he wouldn't take the benefit and he's now waiting to April to get it tax-free. So just goes to show sometimes individuals know more than their advisors, because we certainly didn't know it was coming. If he died in 2014, age 74, tax-free if paid after 5th April 2015. Sadly, our client who died at the end of 2013 was only 57. And that's the case whether it's paid as lump sum or as income. What will happen for lump sums? If you died after 75, then whenever payment is made, the lump sum is taxed. 55% if paid before 6th of April, so hopefully no one's going to be doing that. 45% if paid after 5th of April 2015. Marginal rate if paid after 5th of April 2016. I've got a probably in there because when this was announced, they said they would talk to providers about getting this under PAYE, because if they can't do that, then it may well be that it's still taxed at one rate. If the lump sum exceeds 150,000, at least part of it will be taxed at 45%. If you're a beneficiary and you're receiving a £400,000 lump sum, you're going to go through your various allowances very quickly and with no other income at all, you're going to be paying 45% on £250,000. So the death tax has been abolished? Not quite. What will it look like for income? If death occurs after 75, income will be taxed at the beneficiary's marginal rate if they take income. Obviously, they've got to take income to benefit from that. The beneficiary does not have to be a spouse or financial dependent. And that is a huge change. In the past, you had to be either the spouse or someone who was financially dependent on the deceased or financially interdependent with the deceased. Anyone else, adult children living at home and signing on the dole, were not considered to be dependent, as an example. So the marginal rate of tax could be 0% up to, say, 10,000 in the current tax year, 10,600 next year. And that will, we think, create a planning opportunity. If the beneficiary dies, the tax position will depend on their age at death. So if a client aged 85 dies and leaves the money to his daughter aged 60 and she then dies age 70, any money remaining in the fund reverts to being tax-free, having previously been taxable because the original client was over 75. Again, possible planning opportunities where people don't need the income. And it's regardless of the age of the original member. I've said this could make it attractive to nominate someone under 75 in poor health. That may be a little bit tongue-in-cheek, but if someone comes to you and you're aware that the spouse, although they're younger, is in poor health, it makes nominating them much more attractive. Okay, IHT. Generally speaking, IHT is payable on any money left to the estate or irrevocably to a named individual. The word irrevocably is important because on all the revenue tax forms, it highlights that any payment that is irrevocably to the named individual must be declared, usually on IHT 409. So important to get your nomination in order so that the administrator does not pay to the estate. Take care with long guarantee periods on annuities. We looked at what they could be earlier on. If the provider does not make discretionary payments, and I raised this question with Just Retirement, and they say that on their annuities they're exercising ultimate discretion, and that means that the payments don't form part of the estate. And that's obviously quite an important point to consider. Planning issues, we're now going to face our money in the pension fund generally is not subject to IHT on death. It's also, of course, not subject to any tax on the investment performance, but it could be taxed at 45% coming out of the fund if this occurs after 75. Money taken out of the fund that isn't going to be spent immediately will still be subject to income tax on withdrawal and on reinvestment if that's what you're doing with it. So taking money out of the pension fund is not very tax efficient if you don't need it to live on. It could, on the other hand, be gifted and either form a PET, potential exempt transfer, which means it's free of IHT after 7 years, or it could be exempt as gifts out of normal expenditure. Now, those IHT details are something that you may want to discuss with a tax specialist rather than advising on yourself, but that's obviously up to you as an advisor. Okay, we've got a quick case study here. It's the case study that we used in our technical update, so you should be familiar with the details, but I'll run through them quickly. John died in December 14, age 78. His wife Julie was 68. After April, she can take a lump sum of $165,000 after paying 45% tax. If she does, it will be in her estate for IHT on death. Could use a bypass trust, but tax paid by the trust will be 45%. The point there being that the trust will pay 45% because trusts don't have marginal rates and personal allowances. John and Julie have 2 grandchildren. Each could receive $10,600 tax-free in the next tax year, and that could pay for their education for the next number of years. And once they start earning, they can switch off the payments because maybe they don't need the money and they don't want to pay higher rate tax on it, or indeed any tax, and then switch them on again if not working. Lucy obviously could go on maternity leave, Ben on paternity leave, or either of them could just decide to take a career break. And they could then contribute to a pension, getting income tax back as relief. That's something they could do at any stage with the money, which of course would recycle it back into a fund where it was all tax-free on death. Key points: gifting is subject to affordability. A lot of our clients cannot afford to just gift money to their grandchildren, so nominating the grandchildren doesn't work if Julie needs money. Under a bypass trust, she could take loans, which is a hugely attractive thing if you want to give the money away and keep it, because that's really what she's able to do. And she has the added plus that under the bypass trust, the loans would count as a debit to her estate, so could reduce her estate for IHT. have to consider the death tax post 75, income tax if money is taken before 75 and of any beneficiaries, and inheritance tax. So a lot of considerations there that we're all going to have to consider following these changes. It isn't now a case of if you die, you automatically take the cash out the fund, or the beneficiary does. It's not a case of automatically paying a dependent's pension if they're over a certain age. What does it come back down to? Well, I asked this 7 or 8 years ago, don't you just love simplification? Less than 10 years since it came in, more and more planning issues, more and more opportunities to provide a service to clients. Thank you.
Well, thank you for that, David. Well, now it's your chance to ask some questions, either on the content or anything related to what David's been talking about. Fortunately, I have a couple of questions here to start us off, but please type your questions in and we'll try and field as many as we can. So, David, this question comes from Andrew, and he asks, should trusts still be used in pension planning? And if so, how will they affect the tax situation when income or capital is gifted to the beneficiaries?
Yeah, it's a very good question, that, and it's one that we're all going to be spending a lot of time thinking about. I mentioned almost in passing there that under a bypass trust, the beneficiary can include the spouse who is being bypassed by way of loans. That has an obvious advantage. If the beneficiaries that are younger children, then clearly if the person on death was over age 75, they've missed out on the tax planning opportunity of paying tax at their marginal rate because trusts are taxed at 45%. I think it's a pretty safe bet to say that when you have a bypass trust, you have to make your nomination very, very clear. It's perfectly possible to create a bypass trust and then nominate your grandchildren and invite the trustees of the trust to investigate the tax position before making any payment. So it isn't the case that because you've got a bypass trust, money has to go to it. Clearly, having a bypass trust enables the spouse to receive income after your death, and in a lot of cases that's what you need to do. And the bypass trust allows you to keep money out of the estate. It's worth remembering, particularly for those down south, that with a total allowance of 650,000, you only need to own a half-decent house, and on second death, the allowance has been used up and IHT is payable. And putting an extra couple of 100,000 into the estate for IHT purposes is giving you an 80,000 tax bill that the bypass trust could avoid. And I don't see any way that that will disappear. But equally, if you unfortunately die under 75, when that payment can be made tax-free, then clearly your trustees need to understand how they can pay it tax-free.
Thank you, David. Hopefully that answers the question, Andrew, but if you've got any further questions, please send them in. Another question here from Steve. Will the new pension death benefits give rise to a big increase in defined benefit transfer activity?
This is a very interesting question. Again, the quality of questions is as a start, has been very high, and clearly something we're going to think a lot about. People are also talking about whether the new flexible income will give an encouragement for defined benefit transfers. I think that there's certainly going to be more inquiries about defined benefit transfers, although it highlights that you have to know what the defined benefit scheme is offering as a death benefit. I remember a number of years ago working with a firm where they provided a death benefit on death after leaving a company but before retirement that was broadly equal to the transfer value. This was at the discretion of the trustees, but on the occasions I came across it, they always paid, inverted commas, the return of fund. And that meant that if there was a GMP, they secured that, but the excess would go as cash to nominated beneficiaries. Now, clearly, where that is available, transferring someone into a personal pension doesn't seem to have huge number of advantages to it. There will be occasions, however, where the scheme isn't paying a decent death benefit, and this will be very attractive. The obvious example will be a single person with no beneficiaries who is going to retire and have a pension that's guaranteed for 5 years and nothing further. And clearly where that happens, there will be attractions, because most people who are unmarried will still have beneficiaries they want to nominate. Most defined benefit schemes, the trustees will accept nominations before retirement, but after retirement they'll only pay dependents' pensions to people who meet the dependency requirement as defined in the rules. And again, there may be occasions where you need to go back to the trustees or the administrator and ask for a copy of the rules to make sure that the rules don't allow a dependent's pension to be paid to a common law spouse or adult children who are nonetheless financially dependent. I think that it's actually an area where in the past there haven't been enough transfers. I've probably only done half a dozen in 30 years of doing pension transfers where people have come and said, look, I haven't got long to live, can I transfer my pension and my estate benefit from it in the event of my death? The very first one I did was 28 years ago, where the pension scheme paid no return on death, and unfortunately the chap was already in hospital. And I know it sounds a little bit morbid to be talking about signing up a client who's in hospital, but the fact is that we transferred that into what was then a Section 32. We added additional life cover without underwriting because the insurance company had put that in as a selling point and didn't appreciate what we could do with it. And we've got the lady a return of the fund and 10,000 extra, and she was extremely grateful. Unfortunately, at the time she was showing her gratitude, she had her leg in plaster because she'd just fallen over and broken it. But that's what happens in real life.
I was quite glad it was just the leg that was broken. I thought you were going to say something else, then I have to say. But I've got time for one more question here. This comes from Anne. It's, is there a stronger case, despite what you said about annuities, for people never annuitising?
I think that people should, in 98% of cases, it's a question of not do I annuitise, but when do I annuitise? I haven't covered it obviously in here looking at cross-subsidy, but the fact remains that at age 80, the cross-subsidy on an annuity is about 4%. Now that means that if you don't buy an annuity, you've got to achieve 4% to match the cross-subsidy, even at current gilt levels, 2% to match the gilt yield, and probably 1.5% plus to match the cost of doing it, and that's looking at 7.5% return, and that ignores inflation. So can you achieve a 7.5% real yield? I don't think you can, and that means that by not buying an annuity, you are spending an awful lot on effectively death benefits, because you're saying I won't buy an annuity because I want someone to benefit from whatever money's left in my fund. And it's something that for people who've got money that they don't need to worry about, we've recently signed up a couple of clients. They're only in their 60s, but they may well never buy an annuity. They've got in estate in excess of 3 million, and their pensions are a couple of 100,000 each, and they see those as being for their grandchildren. And that is the classic case where if they die before 75, tax-free to the grandchildren, that's going to be a very attractive reason not to buy an annuity before 75, but after 75 they will be taxable if paid as a lump sum. And like I say, by age 80 you've got 4% mortality subsidy, and if they live for 10 years they're going to have significantly lower income if they haven't bought an annuity. And yeah, if you've got 3 million outside the pension that you take your income from and you don't need income, not a problem. For most of us, we will need to buy annuities. It's just at age 60, the mortality cross subsidy is worth less than 0.5%. And that makes drawdown very attractive if you're prepared to take any level of risk, because you're looking at the equity premium that you're getting from investing in equities rather than gilts, which is what the annuity does.
Okay, thank you, David. Well, I think that we should draw a line in the sand there and stop now. So thank you, everyone, for attending today's webinar. There will be a couple of questions, very short feedback questions as you leave the webinar. We'd be very grateful if you could provide us with feedback and ideas for future webinars. The slides and a CPD certificates are available for those that want them. You can either put that on your survey feedback, or you can phone the office and speak to Claire Bradley, or send us an email, and we'll get those out to you. As I say, it just remains for me to say thank you for joining us. Hopefully you found that very useful. Thank you, David, for your insights. And we're looking forward to doing more of these, and hope you'll join us on future webinars. So thank you very much, and enjoy the rest of your day. Goodbye.